Hello and welcome to my morning note. Well, we've had quite stunning news from Washington overnight. The Federal Reserve has decided to go for QE3, although many people might call it QE infinity, because they are making monthly purchases of mortgage bonds until the unemployment rate improves substantially, and the Fed itself gets to define exactly what substantially means. This is obviously a very aggressive development, very much more committed to attacking unemployment than many people had expected, and it raises a lot of questions. With me now to attempt to answer them is one of Britain's best-known economists, currently the principal of Fulcrum Asset Management and an FT blogger, Gavyn Davies. Gavyn, thanks very much for being here today. Let's start by taking a look at the way that the Fed's dual mandate was pushing them apparently in different directions. We're looking here at, they obviously have to deal with both full employment and with inflation. Why do you think they've done this, given that inflation expectations are not only particularly low, they're actually rising?
Yes, I mean, there's clearly, without question, John, been a change in Ben Bernanke's reaction function. So he's taking unemployment and inflation, and he's now weighting them differently in translating that into policy. He's putting a much higher weight on unemployment than he's ever done before, and maybe we can ask why. And he's actually putting a lower weight on controlling inflation expectations. At Jackson Hole, inflation hardly got a mention. Yesterday in the statement, you know, by Fed standards, with inflation expectations much higher than they've been in the past when he's done QE, it really didn't get a mention either. So he's changed his reaction function, very important thing.
So it's not just a question of some economic data such as unemployment or the ISM new orders that we're showing there looking a little worrying, it's that he is prioritising those more.
I believe so. Now there is a little bit of weakness in the data which has impacted him too, but he said two things in the press conference. One, that unemployment is in danger of becoming permanently entrenched in the system, so he has to move now. And two, a lot of people are disappearing from the labour force. He's putting a lot of weight on this participation rate factor, which he's kind of adding to the unemployment rate. So although the official rate is 8.1%, I'm sure in Ben Bernanke's mind, the genuine level of unemployment is higher than that.
Okay, now in your last blog post on this issue, you had this very interesting chart from one of the presentations at Jackson Hole by a guy called Michael Woodford, who was suggesting that the Fed should be aiming or targeting a particular level of economic growth, as I understand it. Do you think this is actually what Ben Bernanke is now moving towards, and do you think this is workable?
Well, I'm a bit worried about this. Ben Bernanke yesterday shifted somewhat in this direction, but not all the way by any means. But he did say that Michael Woodford was a friend and co-author, which is pretty warm words.
Right.
Now, what Michael has said at Jackson Hole is that what the Fed should do is go back to 2007. This is for nominal GDP, okay? Extrapolate the level to today,
right, and
say we're about 15% below that level now. We will continue to be aggressively easy until that level has got all the way back to its trend rate.
Which implies vastly faster rates of growth than we ever achieved even in the
and I believe, I mean, first of all, is it plausible? I would doubt. But secondly, what it does mean is really ditching the inflation objective, because what it means if we bought the Woodford proposal would be that the Fed would say, we're going to remain aggressively easy, even if inflation goes to 5 or 6%, in order to get back to this line. And Ben Bernanke, pre-commit the next Fed chairman to continue along those lines. Now, that's a lot to ask, I think. I don't think he's all the way there yet, John, but I think he's moving somewhat in that direction.
So, obviously, a profoundly important development. Where do you see the greatest effects on the market? We've seen a spike in the price of gold. We've seen a remarkable reduction in the yields on mortgage-backed bonds, which now at 30 years trading at a discount to treasuries. Is there a way that people are going to make money out of this?
Well, I'm sure those two things will continue. This is great for mortgages, and I think it's great for gold prices too. Risk assets generally, equities and commodities, I think are going to rise for a while on the back of this. They have after previous QEs. The question for me is what happens to bonds, because Ben Bernanke is taking something of a risk, I think, with inflation expectations here. If he starts flirting with this kind of thinking, I actually think the bond market won't like it at all. he's not all the way there yet.
So he might actually be about to awake the bond vigilantes at long
Well,
last.
he's kind of left the door slightly ajar for the bond vigilantes to rush in.
Okay, Gavyn, thank you very much indeed. I find it very hard, as ever, to disagree with him. There are cases for aggressive action, as anybody looking at the US political campaign at the moment will take, but there are a lot of risks in the path that the Fed is taking.